Hey guys, we're back again with another fabulous Charles Schwab ETF. Today we're going to be talking about the Schwab U.S. Large Cap Growth ETF, also known as ticker symbol SCHG. Now this is a fund, if you couldn't tell by the name, it's going to be looking at the biggest large cap companies in the United States. So its objective is to track as closely as possible the total return of the Dow Jones U.S. Large Cap Growth Total Stock Market Index. We'll talk about what criteria the fund has in order to select and screen its stocks here. But how about Charles Schwab, guys? You guys already know how I feel about SCHG. It's one of the best dividend complements. Well, this is SCHG, and it's an opportunity to get a robust growth complement in your portfolio. So let's talk a little bit more about SCHG. So you guys know large cap companies, large cap stocks generally tend to be a little bit more stable. They have a lot of growth potential, but it might be a little bit slower compared to small cap stocks due to their size and market saturation. Think about a company like Apple. They're constantly pumping out their products and they're making lots of money, but in terms of actual innovation, they might only have that every once in a while. Meanwhile, a newer company is constantly innovating, constantly reinventing the wheel, and constantly getting that growth. Large cap stocks also tend to be a little bit more stable, they're less volatile, and that makes them generally a safer investment. Large cap companies also tend to pay dividends, not all of them, but a lot of the big ones do, and they also have established market positions. So guys, SCHG for dividends, now SCHG for the growth complement in a portfolio. Let's talk a little bit more about this fund. So they have a super cheap expense ratio of just 4 basis points. That is uber cheap, guys. That's $4 for every $10,000 invested. People don't realize how much fees eat away at returns over time. Over large periods of time, it can really take away hundreds of thousands of dollars of potential returns, depending on how much you have invested. All right, guys, so this is a way to get exposure to some great companies. This is a low-cost fund, potentially tax efficient. And like I mentioned, it could serve as part of a core portfolio, getting that diversification. It's also super simple. The fund is doing all of the buying and holding and selecting of stocks for you. You don't need to do anything with a fund like SCHG. Just sit back. Once you've bought your shares of this ETF, you're just sitting back, relaxing, spending time with loved ones, potentially even spending some of the gains that SCHG has provided in the past. And that's another reason people like ETFs like this. It's just a passive investment, way to get passive income. And we're going to go over the criteria in how this fund selects its companies. Now, SCHG, they do have $33 billion in assets under management. So you can see here, guys, in the past year, it's up 43%. You can see why so many people trust their money with Charles Schwab. $33 billion, $34 billion basically is a lot of money. It is not a super small fund. Honestly, with a 44% return in the past year and an expense ratio of 4 basis points, we're honestly getting highway robbery here. This is unbelievably good. All right, so how are companies picked? Well, they're going to be picked on a lot of different metrics, but 6 particular ones that I want to call out here, 6 particular performance measurements. There's 2 that they use that are going to be looking at projected earnings. There's 2 that are looking at current earnings, and then there's 2 that look at historical earnings. So the first one we're going to talk about is the projected price to earnings ratio, or projected PE ratio, and this is based on a stock's closing price at the time of the annual review and its mean annual expected earnings per share for the next fiscal period. The next one they look at is projected earnings growth, and this is based on 3 to 5 year annual increases in operating earnings per share. The third criteria that they take a look at is the price to book ratio, or PB ratio, and this is based on the stock's closing price at the time of the annual review and its latest annual book value per share. PB ratio is often used to see the valuation of a company, what it might really be worth. So again, these are all great metrics so far. What's number 4? Well, they're going to be looking at dividend yield. This is based on a stock's closing price at the time of the annual review and the total dividends the company has indicated it will pay in the next 12 months. So I know a lot of you guys like dividends. This is a way to also get a small dividend yield while getting a lot of growth. Next criteria that they look at is the trailing revenue growth. And this is based on the annualized revenue growth for the previous 5 years. Criteria number 6 is the trailing earnings growth. This is based on the annualized earnings per share growth for the previous 21 quarters. So I really like this, guys, because they're not just focusing on what's happening right now or what's happening in the future or what happened in the past. They're actually using a blended approach of all 3 of these to kind of predict what the stock performance might be in the future. If they like it, if it beats out other competitors, it gets bought into this fund as part of its holdings. Now it gets reconstructed every single September and rebalanced every quarter. So guys, this is a way to constantly be getting the best companies out there. Let's move on to their holdings breakdown here. So we have a lot of different sectors. You can see they're heavily exposed in tech at 51%. Next up, they got communications, consumer cyclical, and healthcare, all at the double-digit 12 to 10% range. And then you also have other sectors in here like real estate, utilities, energy, basic materials, all kind of at that very bottom of the brink, 1% or less. But definitely SCHG, it's not a big surprise that tech is such a big part of the U.S. large cap growth ETF because tech is just so big these days. It makes up such a large market cap of the total stock market index. I'm not surprised to see that tech is so dominant here. Now moving on to their top 10 holdings, we'll see that Apple, Nvidia, and Microsoft, these 3 companies alone make up more than 1/3 of the ETF. So for a lot of people, that could be a little bit of a concern. For me, I know that Apple, Nvidia, Microsoft, they are such big trillion-dollar companies for a reason. People love their products. There is a demand for their products. They're going to continue to do well. A lot of them have a lot of artificial plays. Big tech is a winner for a reason, guys. So 1/3 of the fund is in these 3 holdings. Next up, we also have companies like Amazon at 6%, Facebook at 4%, and then Google is separated here. It's about 5% in total. Broadcom, a semiconductor company, at 3%. Eli Lilly, a big pharmaceutical company, at 2.5%. You guys all know what Tesla does. That's 2.16%. So in total, about 9 companies make up 59 or 60% of the fund. That is a pretty sizable concentration on just a few companies. But guys, it's like this for a reason. It's based on different metrics. That's including projected, current, and historical. So I don't think that's actually a terrible thing. And they're constantly rebalancing, picking the best stocks every single year, every single quarter. So I'm not too concerned right now. Altogether, they have 231 different holdings. That means about 221 different companies make up the remaining 40%. So it's still a way to get diversified. Again, very heavy in tech, and lots of people think that tech could be very overvalued right now, but lots of companies are at all-time highs. For me personally, I'm just going to be dollar cost averaging. I'm going to now be buying SCHG almost on a weekly basis because I really like what I'm seeing with this fund. Now, if you're worried about potentially buying in at the top and trying to time the market, just remember this one thing. It's an interesting thought about dollar cost averaging versus lump sum. Think about this. The S&P 500, which has existed for a long time, any choice to buy the S&P 500 has never been wrong in all of history. So what I'm trying to say here, guys, is that there's been several times when the S&P 500 has been at all-time highs, and there's been times when it's meandered, right? But throughout history, people have bought in and out, and there has not, if people had just held on to their investment, there has not been a single time where those people would have been wrong. And I view that the same way with SCHG. Like, sure, the companies that make up the index are going to constantly be reshuffled. I believe in the economy. I believe in these companies that over the long run, they will do well. So this is why I don't really fear buying in at the wrong time. That's why I personally just like the dollar cost average and just buy in when it goes up, when it goes down, set aside a little bit of money every single week. That's personally my choice on how I do my investing. But I think about investing as a long-term buy and hold. It's not a short-term gain for me. And SCHG, they also do pay dividends. Of course, it's a super small yield, less than 1%. But as you can see here, they have paid dividends throughout their 15-year history. They came out in 2009. Just looking back again one more time. So in the past year, they're up 43%. In the past 5 years, they're up 150%. 10 years, they're up 331%. All time, they're up 738%. Now, is this better than income ETFs? Absolutely. Over long periods of time, this will destroy income ETFs since the growth is not capped. Now, for those not near retirement, would I invest in these or income ETFs? It's going to be SCHG all the way. SCHG came out at the end of 2009, so it just turned 15 years old. As you can see, it's returned over 738%. The S&P 500 over that same time span is up only about 370%. And the triple Qs, they've been up a mind-boggling, super juicy 1,100%. Personally, for me, I'm just going to keep buying more and more shares of SCHG basically every week throughout the end of the year until I've reached a point where SCHG makes up a comfortable position in my portfolio where I'm confident that I have enough exposure to it and the potential gains that it might bring me for my portfolio. Now, I've made videos about SCHG in the past, and I'm really kicking myself for not buying it back then. I'm not going to make the same mistake again. This time, I'm going to keep buying SCHG. Did you know that my personal portfolio has ballooned to over $215,000? Did you know you can access it by becoming a Patreon today? Make sure you leave a like. Let me know what you think about SCHG or other growth ETFs in the comments below, and I'll catch you on the next one.
You're going to get really tight pretty quickly. And that's what the military does for me.